Thank you for inviting me to present here in the Asian Monetary Policy Forum in Singapore. I would like to present a safe asset perspective on an integrated policy framework. It's joint work with Sebastian Merkel and Yuli Sannikov. It's a pleasure to be with you, even though it's virtual. We all suffer from the COVID crisis, but the COVID crisis might translate into a big economic recession as well. And how we can manage and mitigate the economic crisis, given the health shock we are suffering, it's an interesting perspective. And we would like to understand in general how to avoid a huge amplification, especially in emerging market economies. If you look at the capital outflows from the emerging market economies, starting with the COVID crisis, you see in the green line how the decline in billions of dollars, how the dramatic outflows from the emerging market economies occurred in March 2020. It's comparing with the other outflows in the global financial crisis, the light blue line, or the China scare, the pink line, or the taper tantrum. And you see it's dramatic compared to any previous crisis. The other important message I would like to take away from that is that all the policy measures which were taken then late March and early April led to stabilization. You can also see that the outflows stopped flowing out pretty much then onwards after 50 days. These are in business days. Now, what I want to do today, I want to go into monetary policy and the interaction of monetary policy with all the other forms of policy. And what monetary policy does, in my view, it relies too much on the risk-free rate, moving the risk-free rate around. But we have to focus on other aspects as well. There are more than one price than the risk-free rate. There's also the risk premium. And the risk premium, it will affect spreads, in particular the term spread and the credit spread. The risk premium is typically the price of risk times the risk itself, where the risk is partly exogenous risk, like the health shock, comes from outside of the system, and endogenous risk, which are due to amplifications in the system, in the financial system, and more generally in the economy. So there are two components, exogenous risk and endogenous risk. What monetary policy can do, it can redistribute the risk, and by redistributing the risk, it will affect the price of risk, indeed the dynamics of the price of risk, and this itself then will affect the endogenous part of the risk as well, where the endogenous part of the risk is all the runs, amplifications, and all these aspects you can mitigate. And what monetary policy should do is to affect not only the risk-free rate, but also the risk premium. And by doing so, it will affect also the economic outcome. Now, for monetary sovereignty, how can you have as a country monetary sovereignty if you have an economy which is dollarized? You don't have your monetary sovereignty. If you have a currency board, you have only very limited power over your monetary policy, and you have to use other policies to control the economy, to manage your economy. The different reason why you might have a different with monetary policy some power over managing your own economy. One is prices are rigid. There's some price stickiness, and the new Keynesian literature focuses very much in what currency is the prices are rigid or sticky, and that determines a lot how the macroeconomy develops. And the cost of this price rigidities are price dispersions. Some firms can adjust the prices, others cannot. There's an output cap and so forth. We deliberately depart from this framework. We go to financial frictions. And the key there is not price stickiness, but in what currency is your debt denominated. And when you do monetary policy, you redistribute risk, you redistribute change asset prices, conditional on shocks. This changes the price of risk, and it also changes the endogenous part of the risk, as I mentioned earlier. On top of it, in such a framework with financial frictions, there's a safe asset, and monetary policy can ensure that you preserve the safe asset status or not. You might lose it to a competing bond or currency. And that's the focus of this analysis here. So it's very much focused on financial frictions rather than price rigidities. Now, in order to understand this, we have to do a little bit of asset pricing, and we have to expand our standard asset pricing framework. The standard asset pricing framework is just saying an asset price is just expected discounted cash flow using a stochastic discount factor. What are these cash flows, dividends or interest payments and so forth? But what's often ignored is that assets also have some service flows on top of it. So even if you don't get any cash flows, you get some service flows. What are these service flows? Which lead to the convenience yield. One service flow is if an asset relaxes some collateral constraint. If you can use this asset as collateral, it gives you the cash flow of the asset plus some help in borrowing against it using it as a collateral. So there's a Lagrange multiplier on the collateral constraint, and this is a service flow an asset gives you. So there's a set of financial assets. If you look at the red bubble there, there's a subset of financial assets which are also good collateral, and actually they're actually more available because they have this service flow as a form of collateral. Then importantly, there is also a service flow which is due to a safe asset component. So what's a safe asset? A safe asset is an asset when you're in need of funds, you can sell it at a stable price easily to somebody else because others are willing to buy it. I refer to it as the good friend analogy. A good friend is a friend in need, and that's also an asset which is available and easy to sell in times of crisis. Why is it available? Because it allows citizens in an economy to partially insure themselves by retrading. So I save some of my money in safe assets, and if I have a shock and if I face a shock, I can sell it, and then I can insure myself against this negative shock. Somebody else might not face a shock at the same time. He might be buying this asset from me at that time. And we retrade the safe asset, and even though we cannot write insurance contracts, contingent contracts, we actually can insure each other by trading the safe asset. Internationally, governments do this too by holding reserves. Reserves is an international safe asset for many governments. So this good friend analogy, an asset which is around in times of needs, that's very, very important. That's a service of an asset. Even if an asset doesn't provide any cash flows or high cash flows, if it provides a service of being around in times of need and is liquid and available in times of need, that's a service flow. And then there's another set of assets, which is a subset of safe assets. This is also called narrow money. That relaxes the double coincidence of wants problems. If you have a barter economy, you always have to have this double coincidence of wants problem. Money relaxes this constraint, the cash and advance constraint or money utility constraint. And this gives you another service flow. That's why this is essentially even more so. If you look at these bubbles on this figure, see the financial assets, there's a subset which are good collateral assets. Then there's a subset of that which are safe assets, they're good collateral and also very valuable in times of need. And then there is money on top of it which relaxes this double coincidence of wants problem. And the more service flows an asset gives, the higher the asset price is and the lower is the expected return, because it gives you less expected cash flow return, but it gives you some convenience yield because it provides these other service flows. So the problem we would like to emphasize here, though, is that the safe asset status, as the money status, which is well known in the literature, is very fragile. It might burst like a bubble. And there's a multiple equilibrium story. So the second feature of a safe asset is the safe asset tautology. An asset is safe because it's perceived to be safe. Others think it is safe. That's why you also consider it as safe. Now, let's understand this a little bit. So let's consider an emerging market economy which issues a safe asset, or at least tries to issue a safe asset, and has capital controls. Think of China or some other countries. The risk-free rate is then the time reference rate rho plus the expected growth rate of consumption in this economy minus the volatility of consumption. That's typically coming strictly out of the Euler equation. If you have low volatility, that's the equation you get. If the growth rate is higher in an economy, the real risk rate is higher. If the volatility is higher in this economy, it can be idiosyncratic volatility because you cannot insure each other against health shocks or other shocks. The risk-free rate is depressed. There's a minus sign in front of the volatility term. Like the risk-free rate, the real risk-free rate in China is not very high. Now, I can assume that, let's say, just for simplicity, assume that the aggregate growth rate is fixed and idiosyncratic risk is causing all this volatility for each individual agent or citizens in this economy. Now, if I just rearrange this equation 1 into the equation 1 point prime, I get R minus G, I put the G on the other side, is rho minus sigma squared tilde. Tilde represents that it's mostly idiosyncratic risk. And this sigma, the risk, is the safe asset service flow. Because we all have, I might suffer a negative shock with a certain sigma volatility, and then I can sell my safe asset because then I need some funds exactly at that time. That's what the service flow represents. And a bubble can typically be supported if R is smaller than G. And when is this the case? You can see already from this equation, if the sigma tilde squared is larger than rho. And if this is the case, and if the government can issue a safe asset, paying an interest rate of R, and the growth rate is larger than the real interest rate on the debt, the government debt, then the government can run a Ponzi scheme. It can issue a bubble. Of course, it cannot issue infinitely many at a very high speed, because then you dilute the existing debt outstanding, and people anticipate that. But in general, it can, issue debt and pay an interest rate of R, which is lower than the growth rate. And over time, the debt to GDP ratio is not going up. Okay? That's very beneficial. It's good to have such a feature in the economy, and that's a very desirable feature. All countries would love, government would love to be in such a situation. Okay. Now, what's also important is to understand that the safe asset, what I told is R versus G, I was ignoring the risk premium because I was assuming the safe asset is there and it will be there all the time. But it might be going away. Even though I have capital controls in place, what really the equation should be, equation one should be like equation 3 now. It is R, the risk rate, plus a risk premium that the asset might lose the safe asset status. There's some risk involved in it, or the government bond might not pay back its debt. And that has to be smaller than G. So this risk premium here can be negative. If you look at the US Treasury, or if you look at Germany or Japan, typically when there's a crisis, the German bond and the US Treasury, they appreciate in value, so it's negative. So it's very easy for Germany or for the US to satisfy this equation or this inequality because the risk premium is negative. It can be positive, so for most emerging and developing economies, this is a positive risk premium because typically you lose your safe asset status when there's a crisis. So the covariance goes the other way around. And hence, there's a positive risk premium, which makes it harder to satisfy this equation. So far I was arguing that we live in an economy which is, controlled with capital controls and autarky. There's no competition across safe assets. Okay, there's the US Treasury or the German bond is not competing with your local safe assets, so the government bond is protected from competition with from other safe assets. Okay. Now, let's now go to a world where there are no capital controls. And now the US Treasury is a competing safe asset. And that changes the whole paradigm. And that's the paradigm we live once you open up the financial markets. And I want to go through a global financial cycle. Indeed, what I will do here as an application, I go through a monetary cycle in the United States. You can see the spillovers coming from the US monetary policy on the emerging economies as a whole. And I would like to understand it. So in the initial phase, the US interest rate is high. Then the US lowers the interest rate, that is our dollar sign. And then suddenly it is possible for the local safe asset to compete with the US Treasuries because the US Treasuries pay a low interest rate. And then there's, I call it the temptation phase, because the emerging economy is then suddenly tempted to issue some government debt at also a low interest rate and satisfy the safe asset status or this Ponzi scheme element. So, but it's not stable. And in phase 3, the bubble might become wobbly. So it's a wobbly bubble or safe asset status. And in particular, when the US increases the interest rate again, the safe asset status will burst away. And that's what we would like to go through the different phases now. Now, let's start with the temptation phase. So the initial phase is obvious, but there's not much to be said about. In the initial phase, it is the case that we have essentially just a high US dollar interest rate, and then there's nothing. There's no safe asset status for the local currency for the starting point. Now, we have a lower US dollar interest rate, and then there's the temptation phase. So what we see in this economy, there's the following balance sheets. There's first the emerging markets, developing economies, government. Then there's a consolidated balance sheet for the household firms and bank sector. And then we have the US foreign or international component of the US balance sheet. What's important here is that now the government debt, domestic markets government debt, can serve as a safe asset. So the government debt is partially backed only by future taxes and by dollar reserve holdings, but only partially, because it also has to be backed by a bubble. Okay. So who is holding this government debt? It's held by domestic citizens, and domestic citizens also hold physical capital, and they have to pay what I also depict in the balance sheet here, which is not on real balance sheets but in economic balance sheets. They have to pay future taxes as well. And they also have some dollar debt potentially towards the US. They issue some original sin dollar denominated debt, and the rest is net worth for the domestic economy. So that's how the economy works. The big difference here is that I put future taxes already onto the balance sheets in order to highlight that the government debt is only partially backed by future taxes and to some extent by this bubble or the safe asset status. Okay, and that's the element, and that's what you typically try to defend as an emerging economy. Now, if now you compete with the US Treasury, because now we remove capital controls, we still have the same condition as before. I just spell out the risk premium in capital letters because it's much more risky now to lose your safe asset status because you now compete with US Treasury. So it's R plus the risk premium has to be smaller than G. And then there's a second condition. You can only get this if your real interest rate is larger than the interest rate you get on US Treasuries. Now you have this condition 3' and condition 4, both inequalities have to be satisfied, and essentially your interest rate is sandwiched between these two conditions. That's very, very important. You're jammed or sandwiched between these two conditions. If you can't stay in this room, and if there's no room like this, then actually your safe asset status is being lost. And notice, it could be that the risk premium is high. That's why you don't satisfy the inequality 3', and because you don't satisfy the equality 3', you don't have a safe asset status, and that makes the risk premium high. So that's essentially self-fulfilling. There are multiple equilibrium here. So the risk premium is high, the price of risk and endogenous risk is high, and because of that, you can't have a safe asset, and that makes it not competitive to have a safe asset. There's another equilibrium where the risk premium is low. You just make your R to be in this sandwich position, but there's some room, you can stay in this room, and there's a good equilibrium where you can preserve the safe asset status. Okay, that's very important to understand. Once you open up the capital markets, you compete with the foreign US treasuries, and that sandwiches you between these two conditions. Now, if you don't manage to preserve your safe asset status, you have a sudden stop. You have exactly what you saw initially of this huge capital outflows. Now, the government debt is not worth so much anymore because the bubble component is gone. The future taxes have to back all of the government debt. So if you now derive the intertemporal government budget constraint, it has to be all future primary surpluses backing it because the bubble is essentially gone. And the households and the firms, including the banks in this economy, they hold still these government bonds and the physical capital, but they don't want to really hold so much. They also want to hold now much more treasuries. Okay, so now the interest rate is higher, the US interest rate is higher. Instead of getting into debt, in dollar-denominated debt, they then want to hold dollar treasuries as a safe asset. So they're much more interested in holding this dollar treasury as a safe asset rather than having a dollar debt. And that makes the whole economy look very, very different. It's a radical shift from one to the other one. It's a sudden stop because the bubble bursts, so the safe asset status is bursting, and that's why you lose the safe asset status, and that leads to radical shifts in the economy. Physical capital has to be sold in order to, pay back your dollar debt and actually acquire additional dollar treasuries, and the economy is going in a downspin. Okay, that's what's going on, and we're very familiar with crisis periods that this is going on. Remember, this is done without any financial sector yet. Even without the financial sector, you have these problems. So what can you do? So knowing that this might happen, so what can you do to avoid it? So first of all, it helps, of course, if the US Fed cuts a dollar interest rate, and that's what the Fed did in March. So that stabilized things. So in March, it stabilized things already. And what can the emerging economy do? So it can do certain crisis measures, expose crisis measures. It can, of course, prop up the fundamentals. So that's one option, to prop up the fundamentals and, raise taxes to the extent that they don't bring the growth rate of the economy down, but help to stabilize the fundamentals. But they can also support the bubble or the safe asset component. How do you support it? One is to impose capital controls on outflows. So citizens cannot flee the country anymore, and foreigners cannot withdraw things. That's capital outflow controls. Remember, the safe asset status is the safe asset are available because you can trade it and retrade it. You have this insurance feature, which comes from the retrading feature, and you can be a market maker of last resort as a local central bank in order to make sure that the government bond is still the market liquidity is very high. So that helps too. And then you can also do some FX interventions. You use some of your reserves in order to stabilize the currency. So whenever there's a speculative attack on your currency, it typically requires some coordination or synchronization among these speculators to attack it. Whenever there's an attack, you lean against it in order to make it harder for speculators to attack and stabilize and support the good equilibrium rather than jumping to the bad equilibrium. And finally, you can also ex ante prepare in the preventative measures to make sure that this is less likely you will lose the safe asset status. You can, for example, limit the capital inflows from abroad, then there will be fewer capital outflows, so that's stabilizing. And you can also accumulate as a country, as an official sector, more reserves, which signals that you will be very committed to do some FX interventions, make it much harder for the speculators to have an attack against that. That's another measure to do. Okay, these are all the policy measures you can do in order to defend the safe asset status. More generally, you would like to have an integrated policy framework, and that's what we're offering in this paper, to assess the consistency of the policy mix between monetary policy, the foreign exchange interventions, capital controls, and later I will also introduce the macroprudential policy, but I have to first introduce the financial sector. What's important here is FX interventions, capital controls, they're substitute to each other, but monetary policy is a complement. So the more aggressive you are on FX and interventions and capital controls, the more room you will have on monetary policy. Now, let's go back to the roadmap. I said, okay, we talked about monetary policy affecting endogenous risk and the risk distribution, the risk premia. We specified fragile safe asset status because it has some bubble component to it. It's a multiple equilibrium story. Then we talked about the three phases of the global financial cycle, interpreted as the monetary policy cycle in the United States, but you can also do risk on, risk off cycle that works the same way. And then we talked about integrated policy measures. What I want to do now is I want to look at the financial sector, add the financial sector, and also add macroprudential policy. Now, if I do this, I have to generalize my balance sheet structure for the economy. So what I do is I just have still a consolidated balance sheet of the emerging market developing economy, except I break out now the banking sector, the financial sector. Now the economy looks the same way as before. I just haven't consolidated the banks with the rest of the economy. I took them out. And now you see that there are some banks in it which issue deposits, and the banks hold some piece of debt from the household and the firm sector in form of mortgages or corporate loans and so forth. And the household and the firm sector is also holding these deposits and so forth. And the banks hold some government paper and the households hold some government paper. That's, in temptation phase, in the second phase, when everything is safe asset status is still there. And as you see here for the government's balance sheet, the government debt is partially backed by the bubble. As it was before, now just the only thing I did is I broke out the banking sector from the emerging market developing household and firm sector, consolidated now without the banks. Now, what are banks in this framework? That's based on the I theory of money. Banks are very good in diversifying idiosyncratic risk. Okay, the banks take some of the households that they have piece of debt, which is default risk associated with this debt, but the banks just take a whole pool of this across many, many households, many, many firms, and diversify some of this idiosyncratic risk away, which typically households cannot do on their own. Okay, and then they issue a much more safe deposit because of diversification benefits, what the banks have. Now, let's now have a shock on the dollar debt. The dollar appreciates because there's an interest rate increase in dollars, or there's some risk of environment shift or whatever. That's a shock. The banks have some dollar debt. That increases the real value of their liabilities. That's a problem. And then the paradox of prudence kicks in. The banks themselves try to be microprudent and actually scale back the activity, they shrink the balance sheets, which is macro imprudent. That's why it's a paradox of prudence, similar to paradox of thrift, Keynes's paradox of thrift, but just in the risk space rather than the consumption savings space. Now, what the banks shrink the balance sheet, they create less as safe assets or less money, and they are also push idiosyncratic risk back to the households and the firms, because typically they take idiosyncratic risk out of the household and firms, diversify it away, and it's gone. But now they don't do it anymore. They push it back, and now suddenly the households have and the firms have more idiosyncratic risk. If they have more idiosyncratic risk, they want to hold more safe assets. Their portfolio share goes into safe assets and out of the physical capital, which depresses the economy. That's essentially there's a decline in the safe asset supply and inside money supply, and there's an increase in safe asset demand. But the key now is to understand, if there's this increase in safe asset demand, will it move into the government bond of the emerging market economy, or will it move into US treasuries? And if you're in an advanced economy, or in an economy, an emerging market economy with capital controls where you cannot move into US treasuries, then this development leads to disinflationary pressure. So everybody wants to move out of physical capital, risky capital with idiosyncratic risk attached to it, into the government bond, in the local domestic safe asset. That leads to disinflationary pressure. If you live in an economy with open borders, where capital can leave the country, you get inflationary pressure because suddenly everybody wants to rush, and the sudden stop element is kicking in much more dramatically. Okay, there's a crucial distinction. If you make the optimal policy framework, it depends very much to what extent you have capital controls on the whole monetary framework and everything. And if the banks hold primarily fixed or non-floating interest rate assets, but then you get the twin crisis, because the banks will suffer from this. The interest rate is moving accordingly, nominal interest rate is going up. If there's inflation pressure, if they have locked in on the asset side a lower interest rate, then they are in difficulties and they have a twin crisis. In general, there's a catch-22 situation. Price stability with no capital controls calls for tighter monetary policy, but it hurts once you hike the interest rate to defend your currency, because people are running in the US Treasury. You hurt your bank's capitalization because they have fixed the interest rate, and this triggers some adverse feedback loop, which means the banks shrink the balance sheet even further, and the whole thing gets further and further amplified. Okay, that's essentially what's going on, ending up in a twin crisis. Now, what I wanted to say essentially, once we put the banking sector in, you see the importance of macroprudential and microprudential aspects to, and how it interacts, how the policy framework has to take all this interaction into account. And if you have a good prudential framework, it essentially protects the banks, and then you have much more room in the monetary policy space. You don't have to hike interest rates to defend your currency, or even if you do it and defend your currency, you can do it because you don't ruin your banks because they're well capitalized, or some other sector which is crucial. So you have more room to create the appropriate monetary policy if you have good prudential framework in place. Again, you see the complements. One, more tight, better macroprudential regulation gives you more room for monetary policy to do the correct things. You're not driven by some constraints to do so. Okay? Now, in this framework, you see already where you're sandwiched. Once you have open controls, no capital controls on it, so once your capital markets are open, you are sandwiched between these two constraints. And even though we have a flexible exchange rates, you will still have huge problems to defend your currency. You don't really have independent monetary policy. So the Mandel-Fleming dilemma is not applicable here, because Mandel-Fleming dilemma would say with flexible currency, you have monetary independence, you can choose 2 out of the 3. Here you have a dilemma. So I'm picking up on this wording by Ellen Ray, who did some empirical analysis. This theoretical framework gives you exactly what you want to and understand what's going on behind the scene, in a theoretical framework. Okay? So we have this dilemma, not trilemma, Mandel-Fleming dilemma, and you see it really spells out once you have this bubbly safe asset status, which you have to defend because it leads to huge reversal and sudden stops. Everything is together in a coherent framework. Now, let's go a little bit more deeply into this and say, okay, how can we make sure that the emerging economies can actually have a global financial architecture which is not so prone to sudden stops, where everything suddenly flies out of it, okay? And again, we have these 2 equations. The real risk-free rate plus the risk premium has to be smaller than G, and the real risk-free rate has to be larger than the dollar risk-free rate. So how can we make sure that the emerging economies can also issue a safe asset? So one thing is to say the emerging economies issues 2 bonds, a senior bond and a junior bond, and all of the risk is concentrated on the junior bond, and then there's no risk left for the senior bond. So the senior bond could be a safe asset because it's much easier to satisfy this inequality 3 prime if there's no risk premium, and the senior bond has no risk premium. So you issue 2 a risky junior bond and a non-risky senior bond, and the non-risky senior bond can be sustained and much easily satisfied in the sandwich equation, inequalities above. And that's very desirable. And the question is, why do the emerging markets economies don't do this tranching? It makes perfect sense. And you can reduce the risk premium even further. You can even get rid of the inflation risk premium if the senior bond is a real bond. So it's like TIPS, inflation protected securities. And that's what you should do to minimize the risk premium to most easily satisfy that. The problem is that sovereigns cannot really commit not to issue later on, once they have issued a senior bond, to issue a super senior bond. And then you essentially dilute the senior bond. And that makes it not credible to issue a senior bond. Who will enforce that you stick to the capital structure you proposed earlier? And for this reason, you need some international arrangement. And ideally, that's what this GLOSP is, a global safe bond for the emerging economies, from the emerging economies. This pooling does. You pool sovereign bonds across various countries, and then you issue a senior bond, jointly a senior bond, and a junior bond. And because of this international arrangement, you cannot issue a super senior bond because it's an international arrangement. This gives you this commitment power. And that's the beauty of this thing is, if there is a sudden stop attack from the speculators, part of the attack will not go into US Treasury, it will go actually from the junior bond to the senior bond. And that the senior bond is also from the emerging economies, so it's self-stabilizing. The whole global financial architecture is self-stabilizing, and you don't need essentially the Fed to intervene with swap lines or the IMF granting short-term liquidity lifelines and so forth, because it's self-stabilizing. There's no intervention needed. That's the beauty of a self-stabilizing global financial architecture. Now let me conclude, and thanks again for giving me this opportunity to present this paper here. In this analysis, a safe asset perspective of the global financial architecture and an integrated policy framework, monetary policy is not only about the risk rate, it is mostly about the risk premia. And you want to redistribute risk to reduce endogenous risk and the price of risk, which then reduces the risk premium. The safe asset status is something very desirable because it allows you to issue at a low interest rate because it gives you service flow, and that might bring it below the risk interest rate, below the growth rate in your economy, and then you can actually have a Ponzi scheme, and that's a very desirable feature to have. And the US has it, Japan has it, many countries have it, so the safe asset status is very nice to have. If it's fragile, it's harder to get because your R has to, plus the risk premium has to be smaller than G. And then if you have open capital control, it's also a problem because you're competing with the risk-free rate of the dollar. And if the dollar risk-free rate is going up, you're sandwiched. And that makes it very hard for you to preserve the risk-free rate. And whenever you know you're subject to the dollar interest rate moving around, you have to pay a risk premium for that. But overall, this framework gives you an optimal integrated policy framework, AMPF, and the right policy mix, which is then consistent across monetary policy, capital controls, FX interventions, where FX interventions might be a way to support the safe asset status. You make it harder for speculators to attack and so forth. And you also bring macroprudential policy into play to give you more room on monetary policy. And finally, this outline provides also global financial architecture with a clause piece to stabilize, have a self-stabilizing financial architecture. All this is actually in a framework which is not a new Keynesian framework, which is purely driven by price rigidities and other financial frictions. Here it's only financial frictions. Not that I argue that price rigidities don't matter, they matter too. Just as an exercise, you want to understand what can we do with only frictions where we focus on a totally different element. We focus only on financial frictions and the safe asset status as a special role to it. And with this, I conclude my talk, and I apologize for taking a little bit more time for delivering this talk. I wish all of you a great time virtually wherever you are, and thanks for paying attention and for listening to me very much. Thanks a lot.